Hi everyone, this is Paul Cooper with Totes and Notes, and this is July 14th, 2019. And instead of bringing another profits and loss video this week, I've had a bunch of requests to do more case studies, especially from a lot of people that aren't on the investor email list. Since the investor email list, I do a lot of them really in depth and give the real world numbers, and a lot of people aren't on that yet. So what I'm going to do this week, and probably do one every week from now on, is I'm just going to do a generic case study. You won't get the addresses. It'll be rounded numbers, maybe not quite exactly, just to get some practice so people can see how you can kind of break down an asset. Some of the research I do. These case studies will be a combination of different things. Some of them will be assets that I've seen in the past that I may not have bought. Some of them will be good, some will be bad. Some of them will be assets I have. Some of them will be assets that I'm currently working on. This should hopefully help people get a better understanding of note investing and how you can kind of look at an asset and the different strategies involved and different things to look for. So this is just a quick disclaimer. The information here is not a solicitation, a guarantee, financial or legal advice. The following information may not be exact and is educational in nature. All individuals should perform thorough due diligence before they invest in any type of asset, whether that's notes, real estate, stocks, whatever. And all investing has a degree. There's always some type of risk. So be very careful with that, and make sure you know what that risk is before you ever invest in anything, and make sure to get a good education as well. So this first asset that we're going to discuss is Amsterdam, Ohio. This is the home here. Pretty nice little home on the main drag. And let's talk about it a little bit more. So Amsterdam, Ohio, if you don't know where that is, and you probably don't, it's a really small rural town in Ohio. Really small. So usually I wouldn't mess with a town that's this small, but this note is part of a tape that we have under an option agreement that we're currently working through, and so we it's an all or nothing thing. You take the whole tape, and this is really the only super small town on the list. So normally that kind of counts against you because you want to make sure that you're getting in an area that people actually want to live, that homes won't sit on the market forever. Small towns can potentially have some issues due to that. Maybe they could have lower rent as well. It just kind of depends. So, but we'll get to that. The unpaid balance, the UPB, is $44,140. Our bid is $14,450. That's a little deceptive because we bid for the whole tape a certain amount, but if you were to evenly divide the bid, well, it's not evenly divided. If you were to divide the total bid up for the tape appropriately based on the values of the homes and where they're located and everything like that, this is what I would assign to it. If I was to buy this, if I had to buy this one solo, like if I just completely disregarded the small rural town and it was in another town in Ohio, then I would be willing to bid about $14,450 for this asset, which is roughly 33% of UPB. And the P&I for this is $388, which annually means that it should generate $4,656 if it was paying. And I don't know if I mentioned this or not, but it is a non-performing CFD. And the interest on this CFD is 9.9%, and it was last paid in April 2016. Now, another thing with CFDs is I usually only like to bid on CFDs if they've made a payment within the last year or so, because that generally means that you're going to have a better chance of getting them to start performing again. First position mortgages, I'll go several years. CFDs, I prefer to get it a year or less since the last payment. But again, this is a tape of them, really good price. And you just need, and when you do bids on something that hasn't paid in a while, just be a little bit more thorough on your due diligence. Make sure that the home's in good condition and a nice area and that's not vacant or anything like that. The BPO for the property is $50,000, and notice I didn't say like my fair market value estimate. We actually had a realtor go by. They verified that the property is still in good condition, and they gave us a $50,000 fair market value. That's for if you're willing to let the property sit on the market for about 90 to 90 days. The super move price, where you want to move it within 30 to 60 days, was about 45. The property on the outside could use a little bit of upkeep, and by a little bit of upkeep, I mean it needs a little bit of painting. I think some of the gutters needed a little bit work, and the landscaping could be cleaned up a little bit. So nothing too expensive, and that was going to boost the price up to what they thought would be anywhere from 55 to 60. So that could be a potential option if we did take the property back, maybe sink a couple $1,000 into it to get it cleaned up. But at the same time, at that price for what we're getting it for and what it's worth, it may just be easier just to go ahead and sell it to the next homeowner. That way they can choose the paint. They can decide if they want to, what they want to do. The property does have a little bit in delinquent taxes, as $1,630 in delinquent taxes. On this tape, the seller is discounting all delinquent taxes as long as I can basically prove the delinquent taxes exist. So I can't just tell them, oh, there's delinquent taxes. Via the collateral file and the O&Es and then printouts from the county, I'm able to show him that it has this taxes, and he's discounting all of that. So it's a pretty good setup. The seller's being very reasonable, which again is why I would buy this asset, as opposed to where if it was just individual, I probably would have deleted this asset because I would have looked up Amsterdam, Ohio, and see that it was such a small town. But it's actually turning out to look like it's a nice little property. And then the estimated expenses for a non-performing note, I usually like to keep them in the $5,000 to $7,000 range. I've done several videos on what goes into the expenses, especially for the investor email. I can't remember if I've done it for just general purposes, so if you're not on there, if you could actually see it. So I'm not going to list everything, but I'll just do a quick deals. That would include things like your special servicing, foreclosure if you have to do that, all of the little banking fees, paperwork fees, maybe little legal fees, collateral file review, all the due diligence. It'll cover that, and then have money to cover virtually all normal foreseen expenses. So really the only time you should have to go further on expenses for an asset would be if something really weird happens, like there's a really strong legal battle. Getting that, or the property needing a lot of work on the inside that you just couldn't tell, or maybe the borrower gets mad if you have to foreclose or forfeiture and they start punching holes in the wall. So sometimes you can't foresee all aspects of the expenses that you might have, but this is a pretty good starting place. 5,000's on the low side. If you're doing several notes at any given time and you kind of have economy of scale, 5,000's probably pretty safe. If you're only doing one or two and you're not looking to do this full time, I would definitely account for 7,000 at the minimum. And whenever I can account for more and the numbers still work, then I'll increase it, because it's promoting good safety, and it's just more prudent. So here are some asset strategies. The number one strategy that we almost always try to do is get the asset to reperform, and then we'll either keep the property for cash flow or we'll do a note sale. That's the best thing for everyone, because now you're buying an asset from a bank, so their ledger's cleaned up. You're going to make money. You and your investor, or if you're the only one, you're going to make money. The homeowner gets to stay in their home. And so you're promoting home ownership. The economy in the area is generally going to be better, because now it's going to not be renters, it'll be homeowners. There's more sense of pride. And then if you're doing that across the nation and more people are able to stay in their homes, then that should help the economy in general. So home ownership's pretty important, and that we like to promote that. It doesn't always happen. Sometimes things happen, but that's the number one strategy. And the basic calculation that we do for that is you take 12 times 388, so it's 12 months in a year, times the P&I, and then you're going to divide that by your total expenses. So remember, I said the bid was going to be $14,450 plus $7,000 for expenses, and that gives you roughly 21.7% ROI. That's pretty good. It's not phenomenal, but it's pretty good real world numbers. What a lot of people will do is they will take 12 times the P&I and divide it by their bid initially. Won't include all the expenses, just divide it by their bid. And if that number isn't at least 30% for a non-performer, then they're generally not going to invest into it. That's kind of a good way to quickly go through a tape. So let's go down to a note sale. So let's say we get the asset to reperform. So we're getting this, and we're like, oh, that's okay, but maybe I want to sell it and move on, get my money out. Well, here's what a note sale looks like. And this is basically what you would put into Excel. I know it's a ton of parentheses, but what you're going to do is you're going to take the UPB minus the annual pay. And remember, the annual pay is this number here, the 12 times 388. And then you're going to take 85% of it, because when you're selling a performing note, generally you're going to get about 85% of UPB. Again, that's going to depend on the value of the property, where it's located. The interest rate is really huge. But that's a good baseline to start at for an initial calculation. So what you're doing here is you're finding out what the UPB would be after collecting a year of payments. So it's 85% of the UPB after you've subtracted a year's worth of payments. Now, you're going to add the annual payback in. And that's going to give you the total number that you would get from selling the note plus collecting a year's worth of payments. Then you're going to subtract out the total expenses and divide it by the total expenses. So basically what that's going to do is now you're figuring out what your total profit is by subtracting the total expenses, and then dividing it by the total expenses will give you your ROI. So a year's worth of payment plus then selling it at 85% gives you a note sale ROI of roughly 78.2%. Pretty dang good. That's another reason why we like this strategy so much. Because one, everyone's winning. You're helping the banks, the homeowner gets to stay, and most of the time, if you get a note reperforming and you do a note sale, you're seeing a really good return for roughly being into the asset for a year to year and a half. So you get some nice paychecks that way. So if you don't need consistent cash flow, that can be a nice way to build yourself a nice little nest egg. And then the REO sale, basically what I do to calculate that is I'm going to take 80% of the fair market value, because you're generally going to want to sell it quickly. So you're going to sell it for roughly 90% of what it's worth. And then you need to subtract out another 10% for expenses that would be covered, paying for realtor, closing costs, and probably taxes on the property. So I find it easier to just take 80% of the original fair market value, and that should accommodate for everything. It actually takes a little bit more out, so that's even more prudent and conservative. So I take 80% of the fair market value, which was $50,000, and then I'm going to subtract my total expenses and then divide it by total expenses, and that gives you an ROI of roughly 86.5%. Pretty dang good. I mean, that makes sense, because remember, our bid was for $14,450, and the home's worth roughly $50,000. So granted, we're going to be into it for a little bit more, because you're going to add $7,000 on here and make it $21,450. That's still more than double. So I mean, that's pretty dang good for an REO, and that's a nice ratio to have. That's where a lot of people say that they love CFDs and non-performing notes, because they get the property back and they get those big home run hits and everything like that. Sometimes you get them, sometimes you don't. You don't want to count on this happening, because if you count on doing that where you're always wanting to take the property back, you're eventually going to get some alligators. You're going to get some where you thought the property was worth that, and then the inside needs to be completely gutted or something like that. So when this does happen and you do get those nice payoffs, be thankful, but that's not my main strategy. And again, the REO sale, while this just looks like three strategies, remember, you could get the REO sale back through either foreclosure, maybe the property's been abandoned, maybe you get them to deed in lieu it over because they don't want it or they can't stay there. There's some different ways to get that. And, these are the three main exit strategies, but there's multiple ways to get to each one. And so hopefully this gives you kind of a good idea of what we look for and with a real world example that we're working on right now. Now here's our final strategy, and not everyone does this, and it really depends on the property, but it's called the 10-10-10 rule, and it's owner financing. So not everyone wants to do owner financing, not everyone wants to write a new note. I completely understand why. Some states it's a bit of a pain. I think it's a very valid strategy that people need to know how to do. And here's basically what the 10-10 rule stands for. You want 10% down, you want a 10% interest rate, and you want the payments to be done in 10 years or less. Now, you don't have to have all three. In fact, you don't necessarily need to have all of them. But if you follow this rule and you get close to it, generally you're going to make more money, you're going to get your money back faster, and if you want to sell the note's going to be more valuable, so you'll get a better price. So let's see how this would apply to things. So the new term would be, we're going to do $50,000. Now here's a key point. I just did that for a quick, easy calculation. When you're doing owner financing, there are two things. Most people are doing owner financing, one, because it's either convenient, or two, the more likely thing is they can't qualify for a normal mortgage because they either don't have enough money for a down payment or their credit isn't going to be that great. So they're either paying for the convenience or they're paying for those issues, or maybe a combination of the two. The other thing is most banks won't create a mortgage that's less than $100,000 because it just doesn't make sense for them financially. They're not going to make that much money off of it. So here's what you do. So because of that convenience, you're generally going to charge them more than fair market value. And it could be anywhere from 5% to 20%. It just kind of depends on what they can do. And so normally I'd probably charge at least $55,000. Again, it's going to depend on the market. Maybe in Amsterdam, Ohio, I wouldn't be able to charge that much more. Maybe I could only get 50. And so that's an easy calculation. We're going to keep it at that. 10 years is 120 months, so that's going to be our term. And I've done several videos on financial calculators, so these are important things that you'd plug in. We're going to do 9.9% interest. And the reason we're doing 9.9% interest is because some states have a cap of 10%. And so if you just do 9.9, it's basically 10%. Then you shouldn't have to worry about any states having a cap. Again, once it gets time to write the note, you spend a few minutes and find out what that state does. If they'll let you do more than 10% and the numbers make sense, then you do more than 10%. But again, nice easy calculation. You know it should be safe. And so you plug these into your financial calculator. So the 50,000 would be your future value, the FV. 120 would be in. 9.9 would be the annual interest rate, and that's going to give you a P&I of $657.99. And so then you can put that, and now that that's in there, what you can do to find out what your yield is you would now put in what you've paid for the note, what it took for you to get to that point. And so our total expenses were $21,450. So you now plug that into the future value, and that'll give you your current yield in the interest area. And so your yield on this setup for this note is 35.72%. Pretty dang good for a performing note. 35%, it doesn't take a ton of these, doesn't take a ton of performing notes at this yield rate to where your monthly cash flow should be covered pretty quickly. So that's a pretty cool thing you can do here. Again, this example does not include the down payment. Including the down payment's a bit of a pain, but just remember, whenever you get paid a down payment, your yield's actually higher because you're getting more money back faster. So this is like the worst case scenario. You weren't able to charge more, and you did 0% down. I wouldn't suggest doing 0% down though. And then, so let's say you're not happy with this 35.72% yield following the 10-10-10 rule for this property. Well, now you can do a note sale. Let it season for 6 months to a year, so you can call it a seasoned performing note. And if you're gonna have to go back to the previous page or one of my other videos to see the formula. But here's the deal: you're gonna get 103.65% ROI. Now, that ROI is probably gonna be spread over a longer period of time because you probably had a non-performing note, and it probably took you 3 to 6 months to maybe get the property back. Maybe the borrower's stringing you on. And then you had to list it and get someone in there. And then you had to write the new note, and then you had to season it for a year. So potentially this could have taken you a whole year and a half to 2 years fairly easy. But that's still 100% over 2 years, so 50% per year. Pretty dang good ROI. I mean, that's really good. If you can't be happy with that, I don't know what would make you happy. But again, it's work. It definitely is work. Now, what I also do when I have my financial calculator out is if I see the P&Is kind of high, I'll also run the calculations at 15 or 20 years just to see what the yields are and everything, just to get a good idea. Because maybe it makes sense at 10 years, but if you have to drag it out to 15 to 20 years, maybe it's not worth it. It just kind of depends on the numbers. So $657.99 is not super high, but it was getting close to basically be market rent in the area. And I love it if my P&I can be market rent or even lower. That way, once they include taxes and insurance, it's at market rent or maybe just slightly above it. Because then you know that you're probably giving that person a really good deal. They're not gonna scoff at your 9.9% interest rate because they're gonna be able to pay each month. And that's the other thing. There's no good setting. That's the other thing. It's no good to set up this note if the borrower won't realistically be able to pay it consistently. And so here's the 20 years, and that was 102.15% if you do the note sale, or 26.67% yield if you kept it to term year after year. So the yield takes a pretty big hit, almost 10%. That being said, 26.67% for a performing note, insane. Again, it's not going to take you long to cover your cash flow needs if you get several of these. But the actual note sale, I mean, it's a little over 1%, 1.5%. I mean, that's not much difference at all. So if you're wanting to do the note sale and get that nice lump sum, you're still good to go at 20 years. And that reduced the payment down to $479.20. So pretty big reduction. I mean, that's definitely below market rent. You include taxes and insurance, and they're still in a sweet spot. So that's just some different things you can do to kind of manipulate the numbers. And you can see some of my other videos where I use a financial calculator. Maybe I'll make another one. Spend some time in it. That'll really help you with the owner financing to figure out if it's right for you. And that's the thing. I don't necessarily want to have a bunch of performing notes for like 30 years. So that's why the 10-year is nice, or just rolling it into a note sale, and just keep the velocity of capital going for you, and just keep reinvesting it. Again, it's going to depend on your wants and needs. If you're not doing this full time, or you don't have the time to do a lot of non-performing notes as far as the work, because it is a lot of work. You make good money doing it, but potentially, but it's a lot of work, and you need to know what you're doing. Then maybe you want to keep some of those reperformers and just get the cash flow, and then you just keep adding your portfolio via a couple of non-performers each year, and you work through them, and whether you get the property back or they keep paying, then you can figure out what you need for your cash flow and keep those, and then note sale or REO or whatever else you need for the others. But hopefully this makes sense. I'm going to have a few more scenarios coming out and some case studies. They're not going to have like all the formulas and everything, because I want those to be a little bit quicker. I don't want you all to be spending all day looking at this stuff. But this is the first one in the series. So again, here are some of the formulas that I use. And if they're ever confusing, don't hesitate to reach out to me. I can break it down in Excel again and really help you out with that. But pretty easy formulas to start with, nothing too hard. The note sale is the most complex one, just because you need to make sure that you have all the parentheses set up. But you can break it up into little parts, and that may be easier for you to calculate. But that's all for this one. Let's get on to the next video. And again, don't hesitate to reach out if you have any questions.